Mixed economic signals suggest for the U.S. economy. Joining us now is Nigel Gault, chief U.S. economist for IHS Global Insight, an economic consulting firm. He's one of a handful of economists surveyed by Bloomberg News who was right on the money with today's upward revision of GDP. So first off, congratulations, Nigel. And secondly, thank you so much for joining us. Let me ask you, I guess the important question, what do you think about this trend? Does it continue, as we heard from our fairly bullish Michael Arenstein today, or does it taper off, as Jared Bernstein seemed to signal?
The growth tapers off. I mean, if we look at the fourth quarter, even more of that growth was coming from the inventory cycle than was first estimated. Almost 4 percentage points of that 5.9 is from much slower decumulation of inventories. Final sales growth was just 1.9%. And so we're looking at major chunks of the economy, the consumer growing slowly, housing flat, and the sales are actually declining right now. So we're relying for growth on the exports and to some extent business equipment spending. They're the fastest growing parts of the economy at the moment, but they're not enough to generate rapid growth rates of 5 or even 4%. I think we should be looking forward to maybe a first quarter slowing down to 2.5 to 3% pace. That's what we're expecting.
But Nigel, let me ask you, because I'm having folks write in about, this kind of inventory conversation we're having. Yeah. And we talked with Michael Arenstein earlier about saying that inventory building up, restocking could go out for several quarters here. I mean, couldn't it be that it was so sharp on the downturn of kind of bringing down those inventories? Couldn't it be so sharp on the upside as well and maybe sustain even stronger growth than everybody's talking about?
Well, there's more to come from the inventory cycle. I mean, we're certainly not done yet because we were still decumulating inventory slightly in the fourth quarter. So as inventory accumulation turns positive, that becomes a bigger boost to growth. But nothing of the order of magnitude of the 4 percentage points that we saw in the fourth quarter. We're looking at something much less than that. So it's a plus, but nowhere near the plus that it was in Q4.
What can we expect from the stimulus? I mean, Jared Bernstein and the White House are quick to claim a lot of credit for the stimulus and what it's done for the economy so far. But they also point out that not half of it has been spent so far. Is the other half going to make the same kind of impact that they claim the first half did?
Well, not if you're thinking in terms of the impact on the growth rate, on the quarterly growth rate, because that's probably peaked. The impact on the quarterly growth rate probably rose second half of the year to the order of 2 percentage points, perhaps a little more than that. But that comes along, of course, as we make the initial phase-in of the spending. Although there's more spending to come, it's not going to be boosting quarterly growth by 2 to 2.5 percentage points. In fact, the boost to the growth rate is going to be fading the deeper we go into the year. So if we're thinking about growth, the effect of the stimulus is going to fade.
Nigel, let me throw something out. Maybe it's going to be crazy, but maybe we don't want growth that is too dramatic, and maybe staying at a 5.7 or 6% rate, because then maybe we have to start worrying about inflation concerns, and that, of course, then puts even more pressure on the Fed to do something more quickly. I mean, does that make any sense?
My own view would be there's so much slack in the economy that we can quite comfortably handle. If we could achieve it, we could handle 5 to 6% growth. We could generate a lot more jobs, and that wouldn't cause us an inflation problem. Though it would be something we'd be happy to deal with. The Fed might have to tighten a bit sooner, but no problem if we're going at a 5 to 6% rate. It's not an inflation issue. The problem is, could we achieve that? I think it's very difficult.
Fed tightening, a lot of people saying not only a bad thing, but it would be nice if they were able to tighten a little bit, and it would be nice for our currency.
Indeed, it would be a good position to be in if we could see that the economy was robust enough, that it looked like it was going to be sustained enough for the Fed to say, OK, we can ease back. We don't need to have an emergency federal funds rate. We can start to move things up. It would be a nice position to be in.
All right, hey, Nigel, thanks so much for joining us. Nigel Gault there of IHS Global Insight.